Hey folks, this is Hyman, and I just want to come to you and talk to you today about setting up your charts to trade successfully. And a lot of times when I see people post their charts, when I worked in a trading firm where I taught them in online courses, they would load up their charts with too many indicators. Here we have three indicators, but sometimes I've seen people with 5 to 10 indicators. But usually, a couple of good indicators is pretty much about all you need on your charts. Otherwise, you get what I call analysis paralysis. And so, just want to talk to you about how to set up your charts and how to make it to where you can trade most successfully by using them. The first thing, really, of course, is just like we said. The more indicators is not better. Matter of fact, some indicators do the very same job, like RSI down here in yellow and the slow stochastics up here do the same job. They're both set up to look the traditional 14 periods back. They're both determining overbought and oversold. Yet sometimes the RSI will give an oversold signal and sometimes it won't. You'll find the stochastics will give an oversold signal when sometimes the RSI won't. Here's another example, a couple of examples of that right here. So I personally prefer the slow stochastics, but I don't have any beef if somebody likes the RSI better. Actually, whatever makes you trade better is what you should use. But before people look at indicators, they should look at the price action. And I found that most people really look at the indicators rather than looking at the road. A driver needs to look at the road and then they can look down and check and see what the speed is doing and what the RPMs are doing and what gear they're in and all this kind of stuff. But the first thing they need to do is look out at the road. And the road is the price action and the trend of that price action. And the indicators are really your gauges. That denote trend or overbought or oversold, and those should be looked at secondarily. So first, look at the price action and what it's doing, because a lot of times people will say, well, I've used indicators and they don't work. Well, what they usually mean is that they've used indicators and they've taken every buy and every sell signal, when really they should have only taken the one that was in the bias of the trend's direction. And so that's one of the main things that you want to do. By the way, let me take the RSI off of here, and you'll see that some of the overcrowding comes off of the chart. And so the slow stochastics gets bigger, the price action in the candles gets bigger to where if you're reading candle patterns, you'll be able to more aptly see them, and it just makes it easier to see the movements, because the movements are still the same, but they look a little more exaggerated when you don't have your price squished down so flat with too many indicators. And so it's actually doing the same thing, but you see it in more fuller swings, and so it makes it easier on the eye to catch a lot of trend changes and to see the overall trend. So basically, the first thing that is good for newer traders to do is to put a moving average on their chart, a simple moving average, or SMA. And that's what this purple line is. I call this trend lines on training wheels. Because maybe when you first start out trading, maybe you know how to draw trend lines, maybe you don't. And that's okay. But you can plot a moving average on your chart just by going to your indicators, putting in 200 and clicking OK, and then making sure you're on the daily time frame, and you'll have a 200 SMA on there. And that's a long-term trend direction indicator. And so you'll see that this indicator keeps heading higher and higher and higher and higher, even though sometimes the price action is a little all over the place. What it's telling you is that even though there's jagged moves all over the place, overall the price trend is moving higher. And so that tells us that we would want to be biased towards buy signals, and we would not want to take sell short signals. And so look at the trend direction first, and then look at the indicator secondarily. So you know that the trend is higher because we started off lower here and we're up higher here. We also know that there's generally starts to become higher highs and higher lows as well. There's several things that denote that, but the moving average is one of the simplest ways, just seeing if it's angled up, angled down, and if the price action is above or below. So if the moving average is angled up and the price action is above it, we're in an uptrend. If the moving average is angled down and the price action is below it, we're in a downtrend. And that's just the simplest way to analyze that. So trend direction first, indicators second, and we don't counter trend trade. It's not that a profit can't be made here and there in doing that, but you generally want to say, okay, the trend is headed upward, so I want to look for buy signals. So when the slow stochastics come down, cross over, and head out of this oversold 20 level, that's a buy signal. So you get a buy signal here, 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 right in here as this comes out, right in here as this comes out of oversold, and right in here as well. So you can see there's a number of signals. And what you would not want to do is sell short in an uptrend just because there was an oversold signal. Imagine if you got short right here, and this pair just kept, riding against you hundreds of pips. It would not be a prudent thing. And so that's why a lot of people say indicators do not work. Well, the first thing is that they just looked at an indicator for all of their signals, and they didn't screen them by the trend's direction. So screen it by the trend's direction, and I think you'll find that you have a lot greater edge in your trading, and it's going to end up putting a lot more money in your pocket over time. So trend direction first, indicators second, which means screen out or don't take counter trend trades. Now, if you had gotten in a buy signal here in the uptrend and it's moved up a good bit and it's been oversold for a while, if you want to take some profits or move some stops up or something like that as a defensive posture, sure, by all means, go ahead and do that. But don't go in and take a new position short just because something got overbought in an uptrend, because it could get overbought, which is not a correct word, but you know what I mean. So the trend is the river, and go with the flow of the river. Imagine how much easier it is to float downstream than it is to swim against the current and go upstream. That's what the counter trend trader is doing. They're trying to swim upstream. And yeah, is it humanly possible? You can do it for a little while sometimes and do it okay every once in a while, but by and large, you can't just get out there and do that all the time. You'll wear yourself out and you'll end up on the wrong side of the flow. And so what you want to do is go with the trend's flow already. An object in motion is more likely to stay in motion, and currencies are no exception. So if the price is moving higher, go with that flow and look for buy signals. Don't look for shorting signals. Look at it as you're going in the direction of the momentum. You're going in the direction of the order flow. When the trend is up, picture more buy orders going in than shorting orders. Picture it that the buyers have more control over the market than the short sellers have over the market. So you want to trade on the side of that edge, and that's the key. And so trading with the trend gives you that edge, and taking only the signals with the trend gives you that edge. And so I hope this has helped you quite a bit. Also, one other thing real quickly, when you're on a chart, look far back in time. So if you're on a daily chart, look about a year back in time. If you're on a 4-hour chart, look about 30 or 40 days back in time. If you're on an hourly chart, look about 30 days or so back in time. Even if you're on a 15-minute chart and you're a day trader or something like that, look. If you can look back 10 days on your chart, look back 10 days on your chart, because you're going to tell trends and moves and things like that with more data to analyze than you are looking at it too closely. So it's almost like if you stand too close to an object, you can't see all of it. But if you take a few steps back, it all comes into perspective. And it's that same way in trading. So that's another mistake that I find people do. They don't look back far enough in time. And so it's something that I would encourage you to do. Also, if you would like to find out more about my service, the Currency Cross Trader, and other services that we've got, just click on the link below this, and you'll find out more information. Thanks so much for watching. Bye-bye.